markets. I mean, Dow's down 1,100 points at this moment in what is shaping up to be a pretty rocky day. Joe, rates are up, the dollar's down. What some have called the Sell America trade is back in full effect. You have the president blasting the Fed chair yet again, referred to him as a loser today. You mix it all up, it's just making the markets uneasy. I was reading this Wall Street Journal piece where they quoted Stephen Blitz, who's the chief economist at Global Data TS Lombard, who says, quote, the idea that you can break trade and not break the capital flow side is a fantasy. And maybe we're witnessing the reality to some degree of all that.
Scott, we do our best, all of us collectively, to try and guide the viewers in the direction of where we could protect their money and ultimately grow their money. And it's very difficult. I've used two words in the last 10 days to describe the environment. First is treacherous. Treacherous remains today. And then mercurial. And certainly the policy is so mercurial and it's impacting markets. Reintroducing the concept that based on cause or whatever the reasoning behind it might be. I know in the Federal Reserve Act in Section 10, you've got that line that says you could remove the Fed chairman based on cause. I don't even know what cause means, but even reintroducing that as we did on Friday is very discouraging. I think it's very discouraging to all investors because I thought we had moved past the potential of that happening. So you go back, you look inside the market, you try and identify, is there an opportunity? And I'm sorry, sometimes the best trade is no trade in terms of long-term investing. Yes, we'll be fine in the long run. I understand that. But if you're looking for something in the moment based on a trade, you're hoping you get a tweet.
I mean, Goldman's Tony Pasquarello, Amy, welcome back. It's good to see you, is still on the capital preservation being the primary objective. To Joe's point, preserve your capital here because the environment is so uncertain, and even though he suggests we may have peaked in terms of volatility, we haven't peaked in terms of uncertainty.
I think that's right. The environment's very uncertain. Look, I think we came into the year with the setup that we needed a perfect environment to justify valuations. And so far, it's anything but perfect, obviously, but we're only down like 10% from the start of the year. So I still think at this point, it's been an underreaction to the news, which has been so jarring. And investors have been anchored with their forecasts, and they're begrudgingly moving them sort of slowly, even though it feels like we've had a lot to take in already. We probably still have more to come. So I agree with that. I think we're still anchored into the 6,000s of where we are. The number of people who have come on this network saying, you know, buy it now. You're getting a steal. Like it's, you know, and I understand looking at technicals, we're oversold in a lot of things, and we could get a snapback. But fundamentals have changed dramatically, and I think that has not been factored into earnings yet. And so
part of the fundamentals, Weiss, is this idea that the economist Blitz puts forward of the capital flight out of the U.S. from the places you would normally have money flowing to. Like the dollar would be a place to come. You know, bonds wouldn't be reacting the way they are, and yet we've had a complete change in the dynamic of that. And no real idea, I think, from anybody of when it's going to cease. That's part of the uncertainty, too.
Yes, I agree. So here's what I'd say. I'd say that foreign investors and domestic investors, including myself, are analyzing this like we would a company. And when we see the CEO...
How do you do that? Well, you can't do that.
Well, here's how you can do it. You can do it from the top line. I can take a look at a CEO that I wouldn't hire for any of my companies because he bankrupted 5 others. I take a look at who are the CEOs of the biggest parts of the government in terms of budget, which is HHS, and it also goes in Medicare, goes into finance, and defense, that have budgets that are much larger than all but a few sovereigns. I see them having no experience. So when you take a look at that, you're saying, can I reasonably invest in this when I never would have hired those people and I would short those companies? So that's the first part. Then you take, and I don't think it's unrelated, you take the news this weekend about Hegseth coming out with, you know, the second signal chat, and you say there's more chaos. This guy really doesn't know what he's doing by putting those people in positions that are critically important to this country. So when I look at it, I agree with Tony. I've agreed with Tony for a long time. I think I was there before Tony. basically since the inauguration day, you can't invest. And your return is ultimately defined by your point of entry. And I still believe 4,000 to 4,500 is where we go. CEOs are frozen. And there's one more thing, Scott. It's misplaced to think that 25 or 100 basis point cut will matter. There's plenty, or there was plenty of liquidity out there. That's not what's going to matter. What's going to matter is knowing that there is a road. Forget about the rules of the road, knowing there is a road where that road leads. And right now, no CEO is going to make major capital expenditures.
That's true. The market's pulled back a lot.
Yep.
Your opinion is but one person's. Brian Belsky, UBS, comes out today and takes everything into consideration and into account and says we're upgrading U.S. equities. They're now attractive to us. They were neutral, but now they're attractive. And they say, while downside risks do remain, we believe the risk of a more severe economic downturn is now more limited. We see U.S. equities as attractive and note that periods of market stress have historically offered long-term rewards for diversified investors who look through near-term volatility. That sounds like something you could have written in your own note, because I feel like you've been making that case as well. What do you think about that call?
Well, thanks, Scott. First off, we spent most of last week in Europe seeing our institutional accounts from BMO. And I guess the theme there is Rome is burning, meaning the U.S. is burning. And remember, most European institutional accounts have been very reluctant buyers of U.S. stocks for 10 years. I guess the number one concern from where they have been, quite frankly, in terms of adding to European exposure is whether or not the fantastic price performance of Europe stocks actually match, or the earnings and the GDP growth going forward can actually match up with the price performance. So they're kind of caught between a rock and a hard place, because they certainly will not come back to the U.S. anytime soon. In terms of investing, that's what we are, investors, and we can't pick when this thing's going to be done. But what we do know is that earnings typically bottom 9 months after this type of activity, and so multiples will probably go up. My team and I are scathing through all 500 stocks in the S&P 500. We're going to come out with a report later this week talking about where earnings are going. But be that as it may, we are aligned with what UBS is saying in terms of looking forward when we have these types of events. And do not be confused. What we have right now are exogenous statements that are causing these ripples, quite frankly, which I'll steal something that Joe said, and I stole it 2 weeks ago. This is treacherous. So now is the time to be more of an investor and avoid trying to pick the bottom or the top.
That's the difference. I don't see this as an event. I see this as long-term, and events with Brexit, events with financial crisis, events with 2015 when oil went below, cash costs.
So what are you 100% in cash?
I'm almost completely hedged. Yeah.
Because
very little exposure.
But to Amy's point, so you don't believe that a social media post literally could cause a reversal in this market?
No, I do.
Faster than you can say I'm hedged.
I do, but I don't believe it'll be sustainable, because the road is already going towards recession. That's the road I see, and going towards stagflation. You take comments that are so misplaced. Now's the time you want to instill confidence in the Fed. You don't want to call somebody a loser who's running the Fed, who's responsible for economic policy, not just here, but in the world by association. So that does you no good. So I do believe that we'll see, in principle, we agree to trade agreement in principle with Japan, but the details will be murky. It's the same type of headline that I'm going to settle the war. I'm going to settle the war in Ukraine.
So what?
First 24.
I guess I'm trying to get to the point. Does that mean, if you see it as a long-term thing, as long as President Trump's the president, you're not going to buy stocks in the U.S. equity market?
Well,
is that what you're saying?
It may ultimately get to a point where he do that? No, here's what could happen. He could take Hegseth out, put somebody that knows what they're doing in. He could take Kennedy out, put somebody that knows what they're doing in. He could take Gabbard out, and he could show that it's not just an echo chamber of sycophants, but people that are willing to challenge him on policies so that he can get to a better place. Right now, it's just an echo chamber.
But I go back to my original question then, because that doesn't seem today as we sit here.
The headlines will pop the market.
Likely.
The headlines will pop the market. It won't be sustainable. Eventually, those headlines will get tiresome. Market will be immune to them because you're going to have the guidance from companies and the actual earnings coming out after the last quarter that are going to be in a further downtrend. And there's no reason why. Somebody maybe it's Brian, should tell me why the market shouldn't trade at the long-term multiple of the last 25 years, which is 16.5, 16.75
Okay,
time.
Brian, tell them why.
Reduced earnings.
Tell them why.
You don't have anything that's keeping you at a premium valuation.
Tell them why.
Well, first off, I love you, Steve, but coming on air and telling everybody we're going to go into a financial crisis, I don't think that's the right message for anyone, especially given the fact that, oh, by the way, the United States of America is still the world's largest GDP. Oh, by the way, we still have the best companies, Steve. And oh, by the way, as I said in my previous comments, when we have a recession, multiples go up. And so looking at average multiples since this, that, and the other thing actually doesn't work, nor does... Steve, hold on. Let me talk. Let me speak, Steve. Steve, let me speak. If you go back to the last 12 months of earnings, we're right now tracking $200. Are you saying that we're going to see another 20 to 30% downgrade in earnings? I'm telling you that is not going to happen, Steve. It hasn't happened in history, so why would it happen now? And oh, by the way, too, I think you're probably, just me saying, you're probably letting your political views and your personal views cloud what's happening in terms of what you're doing in investing. If I was an investor, which I am, I'm going to be adding to stocks now because I want to be in the market for the next 2 years. And I think 2 years from now, the market is significantly higher.
Let me respond. First of all, there are a couple of statements there. I didn't say there's a financial crisis. There's a market crisis, number one. Number two, everybody
you
can
use financial crisis.
Brian, you spoke. I'm going to speak now. Everybody that you speak to, that you have a negative view of what Trump's doing, it's your political bias. Why can't it just be analysis? I'm not a liberal. I'm not a registered Democrat. I'm an independent. Before that, I was actually a registered Republican. So why don't we put that aside? Why don't we leave the death threats out on Twitter, which I'm not on, and all the other stuff? And let's just speak about the facts. The facts are, sure, we're the largest economy, but we're also telling our former trading partners they can't rely on this. And Brian, I apologize for not coming on and being a cheerleader like you. I prefer to state the facts. Now, in terms of being the largest economy, true. Will it be that way forever? Who the hell knows? The point is that the stage is set for a continuing decline. He did not answer your very specific question, Scott, which is justify why we should have a premium multiple on the S&P to what the historic multiple is 16.5 times. We have a premium multiple when you have an accommodative policy, monetary policy. We have a premium multiple when you have clear rules of the road where you know what policies are, not when they change every day by tweet.